Hello and welcome back to the three-part series on stocks, and this is the second part, an introduction to dividends, and trying to be answering the question in this video, what is a dividend? I'll start off with that very question and explain really the basic concept of what a dividend is. I'll then go through which companies do pay dividends, and finally I'll introduce you to what a dividend yield is. So, as I said, the question is what are dividends? And simply it's the company's profits that are paid out to shareholders. And they're also sometimes referred to as distributions. They can be paid out annually, they can be paid out half-yearly or quarterly, depending on what the company wants to do. And it's worth noting that a company doesn't have to pay out any of its profits, or in fact all of its profits, and usually no company pays out all of its profits. They keep some as a kind of buffer for safety. So which companies, to start off with, don't pay dividends? So these are companies that, assuming they're earning a profit, they're reinvesting that profit back into the business to grow that. And a very good example is Amazon, which has had enormous growth, as we all know, for now the last few decades, and they haven't paid a single cent to shareholders. Quite remarkable. They haven't paid any dividends. They just keep reinvesting it to buy new things. So you'll probably see they're taking over everything. They bought Whole Foods in America. They're moving into Amazon Web Services. From starting off just from being a bookseller. So they keep retaining the profits at the start as a bookseller. They retain all those profits so they could buy all these new businesses and just keep on expanding. And you can see the revenue has grown phenomenally from about $7 billion 15 or so years ago to 280 billion today. So even though they pay no dividends to shareholders, the share price has gone up so much, and the reason is because that revenue has gone up and the potential to pay dividends has gone up so much, even though they haven't done it. And everyone's quite happy with them reinvesting the money back into the business because they're growing it so well. And you can see the share price has then gone up from $50 in early 2005 to $2,750 today. That's a 55 times increase over 15 years, and that's the equivalent of a return of 30% per year over that time. So even though you didn't receive any dividends, you still did very well as a shareholder. And that's because you could buy the shares for a low price and then sell them for a high price. Then, which companies do pay dividends? Those are companies that are less focused on growth. They're usually market leaders in whatever industry they're in. They can't grow much more. They don't want to grow anymore. They don't have the expertise to. And obviously this can depend on which industry. They might be almost a monopoly in that, and there's not much room for growth in it. And as I alluded to before, even if they have no room for growth and they're earning their profits and they pay dividends, they'll usually only pay at most about 80% of what they earn a year, and they retain the rest just for safety. So an example of a company that does pay dividends and that fits those categories is Unilever. They're an enormous conglomerate. They're the market leader really in almost everything they do. So they pay quite a high level of their profits out as dividends. And you can see here that the dividends that they paid out, and the dividends usually shown per share. That means if you own one share, how many dollars or euros you'll get for that share in cash from the company each year. You see that that's gone up pretty well over the last 13 or so years, from around 60 cents a share now to 67 cents a share now to $1.80. So that's how much, as I say, for owning one Unilever share you get from them in cash. And obviously compared to Amazon, you got nothing in cash. But the difference is Unilever, because they're paying out all these dividends, they're not really enormously reinvesting it to buy all these different businesses or expand their own business, maybe because they can't, because it's so saturated. Their revenue hasn't gone up that much. It's only been 2% per year, and if you compare that to that exponential growth in Amazon, it's clearly not very much. So as a result, the share price hasn't gone up that much. It's gone from $36 to $55 over these 13 years or so. That's an increase of just 3% a year compared to Amazon's 30%. But of course you have been receiving these dividends, so you have to factor that into account when you are working out your actual return from a business that's paying you dividends. In Amazon, it was just the share price change, but in Unilever, it's the share price change plus the dividends you received on the way. So you can see these two charts, you have to add them together essentially. So for Unilever, over that period, when you include the dividends plus the share price change, you've made about 9% a year. So it's still a very solid return for a company that's quite stable. So the final thing to talk about is the dividend yield. And this is a straightforward calculation, and it will be shown often when a company is referring to how it's attractive maybe for a shareholder. And so it is the dividends per share that I talked about last time, how much you will receive for one share you own per year. It's usually over the last 12 months, divided by the current share price. So for Unilever, if you buy one share for $55 and you're receiving $1.80 or so in dividends, $1.80, you can see here that there's a dividend yield of 3.3%. So you can expect, as long as they keep on paying this dividend, you can see it's quite steady and maybe even increasing. Your yield or your return from owning one share will be 3.3%. It's a bit like if you own a house and you're getting rent from it. Instead, you're owning a share and you're receiving this constant stream of dividends. So that's your return per year, 3.3%, plus any growth in the share price. So that was the introduction to dividends. Thanks very much for watching, and I'll see you in the next video.